Hello and welcome to Pro Trader Strategies Market Commentary for Friday, August the 18th. My name's Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. Please keep in mind that everything that we talk about in these market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, we're here to teach you some different strategies that you can implement into your portfolios, but please do that in your own way. The reason why I can't give you a recommendation on a particular stock or strategy is because I don't know your risk parameters. I don't know what's in your portfolios, and therefore what I'm doing could be counterintuitive to what you are already doing. And please remember that past performance of any trading system or methodology is not necessarily indicative of future results. Having all that out of the way, let's get it on. Not a whole lot of economic data across the pond. We did get German PPI, came in at 0.2%, was expected to be unchanged. Here in the United States, we got University of Michigan consumer sentiment, came in at 97.6 versus the 94.0, so much better than expected there. So that was actually a pretty good number, despite the fact that the rhetoric we're hearing on media about the consumer not being happy with the overall economy and what our president is doing. It seems to be that the University of Michigan consumer sentiment is doing pretty well, which would lead us to believe that that may not necessarily be true what you're hearing on the media. But anyway, onto the overall markets. Crude oil just slightly in negative territory, but the one thing to keep in mind is yesterday we got above this trend channel. Remember, basically on Wednesday we settled in that trend channel. It looked like it might want to start migrating down towards this Fibonacci level right here, somewhere right around $45 a barrel, and test that area. We rallied, got back above that trend channel, and now it's testing the 50 fib level, so which is right there at around $47. We're right on it, so just slightly higher than that, $47.20 some odd cents. So market testing that as well today. Onto the gold futures. Gold futures coming off their highs, up still $2.60 as the overall market was really slumping. Even again this morning, remember we accelerated into the close as negative sentiment. The market really started sloughing off right after I got this video out. That was about midday or mid-market in a sense, mid-range I should say, and then the market immediately started selling off. Remember we talked, it felt like maybe a bit of a dead cat bounce in that area when I started speaking, and then the market accelerated to the downside. That caused gold futures to move higher as there is a flight to quality. Even the bonds, despite the fact that Fed says they're not going to raise rates, you got to put your money somewhere. So in a sense, those flight to quality ends up pumping up those bonds. But today, again, we started seeing the equities come off. That caused gold to spike again. But now that the equities are getting a bit of a rally going on, trying to make some headway to the upside, we're starting to see that come out of gold futures. As same situation with the bonds, almost unchanged, up 3 points on the day. This is what I was talking about, the bonds really rallying yesterday, and basically over 1.5 points to the upside from the lows. Then today, again, another bit of a bounce, but now that, like I said, equities are starting to come back, we're seeing some of that money flows come out of the bonds. Here we go with the Dow Jones Industrial Average, only down about 34 points, let's call it. But again, went down, tested this 50-day moving average, and as you can see, just slightly in negative territory compared to what we saw off of the open. And remember, this is pretty clean as it doesn't take into account the overnight session because it is the index, which only takes into account the day session. Here we go with the NASDAQ. It is in positive territory, albeit it was up probably closer to 5 or 10 points higher a little bit earlier this morning. But at the end of the day, NASDAQ trying to make a bottom here, and as it has done pretty much in the past. This has acted as support right here at this level. So needs to get back above that 50-day moving average in order to kind of get the bulls a little bit of something to hang their hat on after yesterday's settlement below that. The E-mini S&Ps unchanged right here at the value area of where the most time has been spent. Now this has moved up. Remember, this was way down here for quite some time. We've gotten that to move up, so this is becoming more of a valid number, despite the fact that I usually like to look at where the volume nodes are. The volume node for this one being right here. I'm not quite sure why that's down so low, but at the end of the day, volume trumps time in my in my eyes, because volume is really where people are putting their money where their mouth is, where the time node is just kind of where it's settling down in a sense, and it doesn't really mean that price is necessarily being accepted in a sense. Here we are with the E-mini S&Ps. This is what I was talking about with this sell-off. You can see basically right out of the gates in the morning, the market sold off to those lows, and since we've kind of clawed our way back to unchanged, and as we're seeing here, the E-mini S&P is now in positive territory by a 1.5. So the market really trying to claw its way back, and we could easily see this market rally throughout the day as volume starts kind of sloughing off in the afternoons. Rush to the Hamptons, as we called it on the floor. We'll see volume kind of slow down, and we could easily see this market get a bit of a pop on that. VIX really got that big spike yesterday when the market really accelerated to the downside, but today with the market clawing its way back, we're seeing volatility really come out of these markets. So that has helped a lot of my positions, and we'll talk about the ones that I've actually gotten out of in my margin account, but not in my, or actually I've gotten out in my margin account, but I haven't been able to get out of them in my IRA. So here we're going to be talking about with the Qs in my IRA. With the market coming off yesterday, we're starting to get a little bit of that volatility coming out of there. I'm trying to get out of the September 147, 146 call spread in there. So remember, I'm looking to get out of those because I'm short the 146 calls and long the 147s to define that risk, because in an IRA you can't have naked shorts on. So I created that as a spread, and if you remember, I originally sold that for 32 cents, and they're trying to get it back for 16 cents. It's trading around 27. This bit of a bounce here is not necessarily helping me, but hopefully the volatility coming out of that market will, and I'll be able to get out of that sometime today. I'm 7 cents away from it, or 7 cents away from it. So, fingers crossed on that one. But in my margin account, I was able to get out of the September 147 calls, and I originally sold those for close to 50 cents, 56 cents. So I was able to get out of those for 28 cents. So that one is out, but still got my short call spread on in my IRA. Then on to the Philip Morris trade. Philip Morris, I was able to get out of both of these trades in my IRA and in my margin account. In the margin account, I had on Philip Morris, and I had done the September 100, 120 strangle, so the short to 100 puts, short to 120 calls, create that strangle, and originally sold those for $1.32-ish, somewhere right around there, $1.30 something. Bought them back this morning for 65 cents. So that was a trade that I was talking about yesterday, about how, when you have that opportunity to cover them for 50% of your profit, do it. I was trying to squeeze out a couple extra pennies a couple of days ago. Got lucky with the move back right in line there, so decided to take that opportunity to get out. And with the Philip Morris trade on the other side, which was in my IRA, I did it as a butterfly, if you remember. And in that butterfly, I did the September and bought the 110, sold the 115 puts twice, and then bought the 120 puts to create that long put butterfly that I just did the webinar on just recently, so you remember that one. And I originally paid a debit of $1.58, so it was a little bit outside of. Actually, it was right in line with those rules. It was risking one to make two, slightly better than that, as a matter of fact. And then I covered them for $1.94, so right in line with basically taking a quarter of the max profit potential on that, was able to get out. And then on the flip side, when you're doing it with the IRA versus what I was able to do in the margin account, you can see that I was taking less risk with the margin account and was able to get a little bit better profit by taking, making 65 cents or so versus making, 40 cents. So, that's the problem with having to trade in an IRA. You're not allowed to take those risks, but when you're able to take that risk and you have a higher probability, that should be able to be done as far as I'm concerned. But at the end of the day, we're not allowed to do that. So both of those trades, very similar in structure, that if we kind of get right here at this 115 area, that is where you're going to get your profit. I decided to pull the trigger on both of those because it fit my rules. And I didn't want to deal with that market moving around and getting outside of those wings again after I just talked about. I still got my sticky note, stick to the rules. So out of Philip Morris finally. And then on to John Deere. They just had earnings and actually came right in line with earnings, but got slammed on this. I didn't do an earnings trade per se necessarily, but if you guys remember, I've had on this trade forever, and it was the September. Originally what I had done was bought the put spread in there, and I bought the 130, sold the 115 put spread in there because I was a little bit bearish, and that was back on, let me look back here, so 523 was the day I got into that. So that's when I bought that put spread, thinking that we would come down and cover this gap off of the earnings, and thought that would happen, within reason. Obviously, I did that really far out in time to give myself the duration in order to be right, because I didn't necessarily think it was going to happen right away. But then, basically about a month and a half later, I decided with this market rallying that, it was going up and probably going to go test my 130 puts. Decided, I had a lot of risk on the table with this trade. It was a $15 wide put spread, paid $7.53 for that. So I didn't want to lose all of that money, obviously. That would have been a big hit in a sense. So what I did was I went into those September and I rolled those 115 puts all the way up to the 125 puts to collect some more credit. Kind of cauterize some of that and collected $2.88 for that. So I lowered my cost basis on that $7.53 outlay that I originally had to put out for that, and it kind of made it, close to where I wasn't going to make any money at all. I paid almost the width of those that spread at that point, right? But if I could get it to settle somewhere below that 125 area, then I would have been able to collect at least a little bit for that trade. And with this market sell-off, the volatility coming out of that kind of working in my favor, I was able to buy back that September, sell out that spread that I originally paid $7.53 debit, added another $2.88 credit to lower that overall basis. I was able to get out of that trade and sold the September 130, 125 put spread in there for $4.95. So if we take that credit, add the $4.95 to the $2.88 credit that I got, that puts me at about $7.83. So $7.83 total credit for that, and I originally paid $7.53, so 40-cent profit on that trade. Obviously, had I not done anything, I would have been able to have a lot more to show for it, in a sense that I probably would have been up about $7 on that trade. But at the end of the day, we need to stay mechanical. We can't look at hindsight for trades. We have to look at what we're doing right now and make sure that we're staying mechanical. And that's exactly what I did with this particular trade, was just went mechanical on it, looked at it like, all right, well, I'm just going to limit my risk, continue to collect credits, and work it out that way, and that ended up working out in my favor for that. I'm also trying to get out of XLI in both my margin and in my trading account. It's quite a bit away actually, so not a whole lot to talk about there. I just put it in as a GTC in my IRA. So looking to work to get out of that one. Today's webinar, we're going to be doing it on the long call calendar, which is perfect for right after these earnings seasons. Deer got really beat up for the most part on this bearish market assumption across the broader board. They came in line with expectations, came in at $1.97. I think it was just supposed to be maybe $1.97.43 or something ridiculous. At the end of the day, in line with their expectations. I think that this market is going to be bullish throughout, and I'm going to probably be looking to do a long call diagonal in Deer, and so you can find out how to set that up to increase your probabilities of success with that trade. I know you can figure it out online, but at the end of the day, I'm going to show you how to set this up to limit all of the extrinsic value that you'd pay for this particular underlying. All right, so if you can't take that, take it easy.